Today we're going to talk about an optimal intertemporal allocation problem. We'll have a couple of time periods, a starting amount of cash, and we need to figure out how much should we invest and what is the present value, the future value. We'll talk about interest rates and so on. So this is what the problem will look like. It looks a little daunting, but we'll break it down into its component pieces and go from there. So let's just start with a question. So in the following figure, the sloping straight line represents the opportunities for investment in the capital market. So sloping straight line, that's that one. And the solid curved line, that represents the opportunities for investment in plant and machinery. So we're talking about this curve. So the company's only asset at present is $2.6 million. That's where we're at. And now we got to answer these questions. But before we do that, I want to talk a little bit more about this curve right here and talk about what it exactly means, because understanding that is a fundamental piece about this problem. So let's break it down. So we know that we're going to have a couple of time periods. So we're going to have today, that's going to be on the x-axis, and tomorrow, that'll be on the y-axis. Now in the real world, right, we're going to have more than two time periods. You'll have today, tomorrow, the day after, and so on. But just to make things a little clearer, we're just going to talk about two time periods. Now it says that the sloping straight line represents the opportunities for investment in the capital market. We'll get to that. There's a solid curved line for opportunities for investment in plant and machinery. And this is the next part is where we're going to start. The company's only asset at present is $2.6 million. So we know that today this company has $2.6 million. And some people get confused here and they say, well, if I have $2.6 million today, doesn't that mean that tomorrow I also have $2.6 million? Well, if you don't do anything, that's true. But if you think about a present value formula, right? Present value will equal what you have today, and you can discount that back if you want, but you discount that back at zero time periods, plus what is the cash flow coming in tomorrow? But if you don't do anything with that $2.6 million, nothing comes in tomorrow. So you'll have 0. 1 plus r to the 1, which means your present value is 2.6. So yes, you will have that $2.6 million tomorrow, but nothing else is coming in tomorrow. No new net amount. So this is where we start, $2.6 million. Now the next part is to figure out, we're going to talk about is this solid curved line, which represents the opportunities for investment in plant and machinery. Now what that means is, think about any company, Amazon, Microsoft, Boeing, or whatever. They have a certain amount of cash that they can invest in projects, right? Building new planes, making new software, and so on. Now I want to draw the curve first, and we'll talk about why is it shaped that way. So if you remember before, it was kind of like this curved line. Now it's shaped this way because, and just to talk about it first, then we'll dive into how does it mean what I'm saying it means, is think about a rational person. You, I, were presented with a few opportunities for investment. What are we going to invest in first? Well, we're going to invest in the things that give us the most bang for our buck. Once those are done, we'll go and invest in something else that gives us, some bang for our buck, but not as much as the initial investment. And so on, until there's no opportunities left. So let's say, what does that mean? So let's say we were to invest up to this point. And let's say this represents 2.1 million. So that means we've invested 500,000, right? Because we had 2.6, now we have 2.1, which means we've put in 500,000, which is giving us some return tomorrow. Because we're investing $500,000, that'll give us some money tomorrow. Let's imagine that amount is, I'm not sure, $2 million, right? So this is a world where if we were to go back to this present value formula, if we were to go back to this present value formula, we would see that it's 2.6 over 1 plus r to the 0 plus 2, because now we're getting $2 million tomorrow, over 1 plus r to the 1, which gives us, something. We don't exactly know what it is because we don't know what r is. So anyways, so now we've invested 2.1. Let's say we invest another 500. So instead of 1.1, now we're at 1.6. That 1.6, what is it going to give us tomorrow? We'll say it's going to give us 3 million. You'll notice that this distance here is smaller than this distance here, which means for that first 500,000 we made 2 million tomorrow. For the next 500,000 we only made 1 million, right? So we had 2 and 1. So because this line over here is getting shallower as you move, right? It's getting shallower. It starts off steep and then gets shallower. What that tells me is that even though if I put in the same amount, because I've already done the most profitable projects first, there's only a less profitable project left. And that gives me $2 million. Okay, so let's say, so we just talked about a solid curved line. And now we're going to talk about the opportunities for investment in the capital market. Opportunity to invest in the capital market. What does that mean? Think about that as just investing in the market. In this example, think about it as a savings account. Let's say that you could always get back some return R, right? Which I don't know, it could be 5%, 6%, 7%, and so on. We don't know what it is, but we'll actually figure it out when we actually start this problem. So let's say that we're talking about 5%, just for hypothetically saying. Let's say we were talking about 5%. Now, let's say we know at minimum we can get a risk-free 5% return. And this is a simple example. Nothing is risk-free unless you invest in kind of treasuries in the market. But for this problem, let's assume this is a 5%. This is the least we're going to get. So let's say we're back in this world of investing in this curve right here, right? We're talking about this curve right here. We know we can always get 5%. So we're only going to invest in these opportunities when we get back more than 5%, right? At some point, this curve will generate less than 5%, in which case we're not going to do it anymore because we know that we could just get 5%. So let's say that we are over here now. We've invested some amount, which I don't know, could be 1.7 million. Now, we know we can get 5%, and let's say that this is the point at which the next investment gets us 4%. So rather than invest in that, what we could do is we could either borrow, which would put us down this way, and we'll talk a little later about why it does that, or we could lend out and get more tomorrow. So just easily speaking, or just at a very simple level, if we're at this point, we know we have 1.7 today, and maybe we have something like 2.5 tomorrow. If we wanted to consume more today, that would mean we want to move down this curve, right? Which means more today. How could we do that? Is we could go to the bank and tell them, hey, I have 2.5 million coming in tomorrow. Will you lend me some money against that at 5%? Or vice versa, let's say I wanted to consume more tomorrow and less today. I could go up this curve, take the money that I have, this 1.7, stick it in the bank, some of it, which means I would get a 5% return. So depending on whether we want to borrow or lend, we're going to either move up this curve or down this curve. And again, we start at this point here because this is a point at which we no longer get above that 5% from our existing investments. So we're going to go to the sure thing. Now, an irrational person may invest up to this point, and then they could say, okay, well, I'm here now. I have, I don't know, 0.5 million and 3.2 million. And they could start borrowing and lending from there at 5%, which would give them this curve. Now, you will notice that this curve, the second curve, is always below this other curve. No matter where we look at it, we are sitting below. So yes, we could do that, but we're assuming we're rational, we make smart decisions. Why would you want to be on this curve when you could be on this higher curve right there? So that's what this curve is really telling us. Now let's go to the next slide and start answering some of these questions. And one more thing that they've actually told us, which we'll get into later, is this is the curve we drew. Here's the straight line. Here's the borrowing and lending line we talked about. They give us one more item here, which we didn't talk about, is this point right here. That is the owner's preferred consumption pattern, which will come in later when we figure out what does this person actually want to do. we don't really know if they want to invest in more today, less tomorrow. They may have specific consumption needs that they need, which is causing them to say, I want to be at this point. And we'll get into that. But let's go back and say the first question. So first question is, what is the interest rate? Well, let's see. So we know that today we could have 4. If we take everything we have, we could borrow against it and have 4 today. We could take everything we have today, invest it, and have 5 tomorrow. So we know that we could have, so we know that 4 times 1 plus the interest rate could give us 5, right? If you take everything we have today, stick it in the bank at R percent, we could get 5. So 1 plus R equals 5 over 4. R equals 5 over 4 minus 1. That gives us 25%, which is the interest rate. Vice versa, we could talk about something else. So let's see. Similar way to look at it is, let's say we're at this point where we have 1.6 today and 3 tomorrow, right? What we could do is, we know if we take this 1.6 and invest it at 5%, that'll allow us to go from 3 to 5, right? So that'll give us an extra $2 million. Because we invested the 1.6, that gets us from here to here, a distance of $2 million. So we know that if you take 1.6 times 1 plus R, that should give us 2. 1 plus R equals 1 plus R equals 2 divided by 1.6, which is, 20 over 16 divided by 4, which is 5 over 4, and we're back to the same place. R equals 5 divided by 4 minus 1 equals 25%. So a couple ways of looking at the same question. And you can do this, similarly, if you took the 3 and borrowed against it from the bank, you could go from 1.6 to 4. Everything will kind of give you that same 25% because you're just simply moving up and down this curve, this line, which, because it's a line, you're always going to have that same slope. But this is a very intuitive way to think about it. Next, how much should the company invest in plant and machinery? So we know we started at 2.6. And if you remember earlier, we talked that the individual is going to invest up until the point that they get the same amount of return from their plant and machinery that they are from the capital markets. So in this case, they're going to invest up until this point, because we see once we get to this point, rather than move up the curve anymore, we're going to start moving up and down this line. So they went from 2.6 to 1.6. That's a distance of $1 million. That is how much they should invest in plant and machinery. How much will this investment be worth next year? Well, this is a simple question, because originally we were at 2.6, which meant we had 0 next year. Because we invested that $1 million, that allows us to get an additional $3 million next year. So we know that this will be worth $3 million next year. C, what is the average rate of return, or D, what is the average rate of return on this investment? Well, if you look at D, how much will this be worth next year? We know we get a return of 3. We know that has to equal, how much did we put in? We put in $1 million, if you remember from B, so that was 3 million, or 1 million, and that was 3 million. So we know that 3 equals the $1 million times 1 plus R. 3 equals 1 plus R. 2 equals R, and that's a 200% return. Pretty good. Next, what is the marginal rate of return on the investment? Now this is where we have to think a little bit. This is a kind of an intuition question. So marginal rate of return, in essence, means for that last dollar that we invested, so we started at 2.6, we invested, we keep investing, right? We keep investing until we get to this point. Now what did that last dollar give us in terms of a marginal rate of return? Now, if you remember, what we said is that we're going to keep investing in plant and machinery up until the return on that plant and machinery equals or right before it falls below what you could get by investing in this straight line right here. What do we say from 1? If that straight line allows us to get 25%. So we're going to invest in this line up until it falls below 25%, or even more correctly, up until it is 25%. And this is, in the real world, you can't just invest a single dollar, right? A project has a finite amount, 200,000, 300,000. It's not like you can just invest one. But this is a simple example just to help us learn the concepts. So in this case, the marginal rate of return on this investment is 25%. Because if it was 24%, we wouldn't invest in it anymore. We would instead go to the capital markets. So that's that. Next is, what is the present value of this investment? Well, we know that the investment will return $3 million to us next year. In a simple, present value formula is, your x divided by 1 plus r, where x is your return next year. In this world, not next year, but tomorrow. So what we have is 3 divided by 1 plus 25%, which gives us $2.4 million. Now, there's actually another way to think about this question that we're going to talk about. And that is, we started with 2.6, we went down to 1.6, but because we invested in this, right, we got 3, and what we could do, right, is we're at this point, is we could tell the bank, hey, I have $3 million coming tomorrow, will you please lend me some money against it at 5%? That allows you to kind of move down this line. If you invested all of it, or not invested, if you borrowed against all that $3 million, you would have $4 million today. So because you invested, you were able to consume 4 from 1.6, which means this investment allows you to gain $2.4 million today. So that is your present value. Another way to think about that. What is the net present value of the investment? Well, we know that NPV is simply present value minus cost. From before, the present value was 2.4, cost was 1 million, so we know that that's 2.4 million minus 1 million. That gives us 1.4 million. Similar to how we did before, let's talk about it from another way. So before, we know we could get up to $4 million today. We started at 2.6 at the very beginning. Because of this investment, it allowed us to go from 2.6 to 1.4. So in the same manner as before, we know that that could also be equal to 4, which is the max we could get today, minus what we started with. So that investment had a net present value, once you take into the cost, again, $1.4 million. Next, what is the total present value of the company? Well, if we took everything today, right, we could have $4 million. Hence, that is the total present value of the company, $4 million. Another way to look at it is, if we invested everything we had, we could have $5 million tomorrow. That's the max. 5 million divided by 1.25 as the interest rate is $4 million. So again, $4 million. Two different ways of looking at it. How much will the individual consume today? We don't really know, right? We know that this individual will lie somewhere on this line. That's all we know. And because they've invested up until this point, now they can either borrow from the bank and move down this way. So that's borrowing. How do we know it's borrowing? Well, they're at 1.6. When you borrow, you have more today. So that gives you 2.6. When you borrow, you have to pay it back, so you have less tomorrow. Hence, you move down. This is lending. Instead, we lend to the back, lending / investing, in the capital markets. So we were at 1.6. If we move up, that gives us less today because we're moving this way, and more tomorrow because we're moving up. So what we know from this example, or what we were being told is, let me erase some of this, is that this is the owner's preferred, let's see if we can get rid of that. Okay. This is the owner's preferred consumption pattern. For whatever reason, this individual wants 1 million today and 3.75 tomorrow. You know, maybe they only need $1 million today to pay their bills, and they figure the rest they'll put in the capital markets, or maybe they need 3.75 tomorrow to pay a bill tomorrow, and they're okay with having one tomorrow. In either case, they're going to consume $1 million today. How much will he consume tomorrow? Well, we just talked about that. Because he consumes one tomorrow, that puts him on this point in the line. That gives him 3.75 tomorrow. It's 3.75 million. And then lastly, is he a borrower or a lender? Well, we know in an optimal world, he's going to start with 2.6. He's going to invest up until he has 1.6 today. And then he has an option to move up or down this curve. What we know is that this is an optimal point, so he's actually going to move this way. Is he a borrower or a lender? Well, one way to look is he's 1.6 to 1 today, or tomorrow he would have started with 3 and he goes to 3.75. So is he a borrower or a lender? Let's think about it. We already talked about it, but let's talk to the intuition again. Starting at 1.6, 1 tomorrow, that means that he is lending, right? He's okay with less today, so he's lending money to the bank. Likewise, that gives him 3 to 3.75 tomorrow. Now, on the other flip side, he may have gone from, you know, I don't know if the numbers will work out, but let's say it does. So he'll start at 1.6. He could have gone to 2 tomorrow, and that would have made him go from, 3 to, something less than 3, which I don't know, it's probably not going to work out mathematically, but we'll just say 3 minus tomorrow. In this world, because he has 1.6 and then 1 tomorrow, he's a lender. In the world that he would have had 1.6 and he moves to 2, well, that makes him a borrower, right? Because he wanted more tomorrow or more today. So in this world, since we're talking about this scenario, this individual is a lender. So that's the question in a nutshell. There's a lot of pieces that go into it, but once you understand this curve right here, the curved line, the straight line, why does the individual stop at this point, and then why does the straight line kind of come out of that point? Well, then you see why it makes sense, right? So rather than look at it from a mathematical perspective only, I hope this has provided some intuition and some more rationale and more descriptive type learning, which I think helps, rather than memorizing equations, we're just talking through it from a common sense standpoint. So hope that helps, and stay tuned for more questions about MBA finance. Thanks for watching.